Hi, this is Lara at Elliott Wave Stock Market with an extra video update for you after the session Tuesday 7th of June has closed. Again, I was expecting downward movement, but we don't have confirmation of a trend change. I'll still be expecting this upward trend is going to end either here or very soon, but we still don't have confirmation of a trend change. While we don't have confirmation, there is still further room for price to rise. The invalidation point for the bear count still at 2134.71, the all-time high. Upward movement is persistently weak, and so a trend change sooner rather than later, at least for some pullback, is expected. If we see a new low below 2085.36, I'll have reasonable confidence that it's underway. A breach of the black channel on the daily chart would provide quite a lot of confidence, and finally a new low below 2025.91 would provide final price confirmation that we have had a trend change. How fast and how low the next wave down goes is going to tell us which count, bull or bear, is correct, and there's only one bear wave count now, this one. From the all-time high here, the bear wave count sees a leading expanding diagonal complete here, and now a zigzag may be either complete here or very close to it, finding resistance at this final line of resistance, the lilac trend line. This trend line is drawn from the all-time high to the swing high here, labelled intermediate wave 2. And this is a weekly candlestick for the week ending 19th of July 2015. Extend that line on outwards with a weekly chart on a semi-log scale. An upward movement for today's session has come very, very close to touching this line. If we get any more upward movement tomorrow, I'd expect it to find resistance at that final trend line. For the S&P, price has been boxed in essentially since the week back here in August 2014. Essentially, we've had overall sideways movement within this big range. We can be certain that price will break out of this big box, and it's more likely to be downward than upward because during this range we have stronger volume for downward weeks than we have for upward weeks. So far, up until today, we had lower lows and lower highs, but now we've got an important new high above this major swing high here, and we've got a couple of daily candlesticks above the bear market trend line. It's not quite enough yet to tell us that the S&P is in a bull market and that the bear market is over. For that, I would want Dow theory to confirm it, and the transportations are quite a long way from confirming that the markets are again in a bull market. This is a leading expanding diagonal. Within a leading diagonal, subwaves 2 and 4 must be zigzags. Subwaves 1, 3 and 5 within a leading diagonal are most commonly zigzags, but sometimes they may also seem to be impulses, and so that's why you see the third wave here labelled ABC, and that's the only time you'll see a third wave labelled as anything other than an impulse. This is a third wave within a diagonal. It's a zigzag. Importantly, from this high to this low, this bear wave count has a much better fit than the bull wave count. The bear count can see this downward movement as a zigzag. It would be most likely intermediate 5 of the leading diagonal would be a zigzag. It subdivides 5, 3, 5. The bull count has a big problem with this movement. We'll get to that later. Leading diagonals can't have truncated fifth waves. This one obviously isn't. It moved beyond the end of the third. The diagonal is expanding. The fourth wave is longer than the second. The third wave is longer than the first. And the fifth wave is longer than the third. The trend lines diverge. All rules are met for this structure. Following a first wave leading diagonal, the second wave correction is usually very deep, and this one is now 0.95 the length of primary 1, certainly fitting the description of very deep, and it's the most common structure for a second wave, a zigzag. Okay, let's look at the daily chart, where the leading diagonal may have ended down here, and here we have a 5, 3, 5 zigzag, which may be complete, but the fifth wave certainly could move a little bit higher. If it's over here at the high for Tuesday's session, now we have within intermediate wave C, minor 3 has a 1.618 Fibonacci ratio to 1, and minor waves 1 and 5 are close to equality, with 5 being only slightly longer. The variation is less than 10% the length of minor 5, so I consider that an acceptable Fibonacci ratio. We've got a couple of upper wicks on these candlesticks, but they really aren't huge, so that's it's not a very strong bearish indicator. I think the strongest bearish piece of evidence on this chart would be the strength of this lilac trend line. I would expect it to hold, but then I had also expected the cyan line to hold, and it didn't. And so we have to accept the possibility of more upward movement while we have zero confirmation of a trend change. The invalidation point absolutely must remain at 2134.71. I have a couple of very provisional targets on this chart for you today. If primary 3 exhibits a Fibonacci ratio to primary 1, then at 1593 it would be 1.618 the length of primary 1, and at 1269 it would be 2.618 the length of primary 1. But primary 3 doesn't have to exhibit a Fibonacci ratio to primary 1. It's somewhat likely it will, but it's not absolutely certain that it will. When intermediate waves 1 through to 4 within the impulse of primary 3 are complete, and it may only be an impulse, at that point in time I'll be able to calculate the target at 2 degrees, and so at that point in time, toward the end of primary 3, these targets may change or widen to a small zone. Primary 3 has to be an impulse, and it should show an increase in momentum beyond primary 1. It should also show an increase in average true range once we get toward the middle of it. During bear markets, the S&P can behave somewhat like a commodity. Intermediate wave 1 doesn't have to show very, very strong downward movement and strongly increasing daily range. ATR may remain, particularly for the early stages, around about 20, where it is fairly close to that now. It doesn't have to show strong downward movement. At this stage, we're just looking for a first wave down. Think of the next wave down as a first wave, not necessarily thinking of it yet as a third wave. It's not until we move toward intermediate wave 3 of primary 3 that I would start to see a very strong increase in momentum and a very strong increase in daily ATR. And when we get toward the end of intermediate 3, it may end with a very sharp, swift thrust to the downside, typical of commodities. That's how the S&P likes to behave during bear markets. At least that's how it behaved during the last bear market. Now, it doesn't mean it has to do that again. It just means it's fairly likely it could behave in a similar manner. Let's have a look at the hourly chart, and we'll look at all of intermediate C, where the end of intermediate B, which was a double zigzag, ends here. So far within intermediate C, we may have 1, 2, 3, 4 and 5 again could be complete, but it's not confirmed yet. Price remains within the channel that contains intermediate wave C. This is drawn using Elliott's second technique. It remains above the cyan trend line and within the black channel copied over from the daily chart. So we have zero confirmation that we have a high in place. This is a tentative labeling. It comes with the caveat that it's certainly possible for minor 5 to continue higher for another day or so, although it certainly looks like upward movement is becoming increasingly weak, especially for the last 2 days. Here, minor wave 3 exhibits a Fibonacci ratio to 1, and the middle of minor 3 shows the strongest upward momentum. Here's minute wave 3 of minor 3, and it overshoots the upper edge of this channel. That's a pretty typical look for a third wave, so I'm pretty sure that for this impulse, which did begin back down here, I've got the labeling of the middle of the third wave right. My only question is, have we got the end of the fifth wave? We have the strong persistent divergence between price trending higher and making new highs and MACD trending lower at the hourly chart level, and that's what you'd expect to see for the end of an impulse. So far it all looks right. If we see a new low below 2085.36, that's the start of minor 5. A new low below that point could not be a second wave correction within this final fifth wave. At that stage, the fifth wave would have to be over. That would add some price confidence to the idea of a trend change. That would also come with a breach of the blue channel at the hourly chart level. I really would want to see this black channel properly breached at the daily chart level. I define a breach as a full daily candlestick in this instance, below this lower black trend line and not touching it. When we get that, then I would have some trend channel confirmation of a trend change. A new low below this point, 2025.91, could not be a second wave correction within intermediate C, because no second wave correction within this impulse may move beyond the start of its first wave. The same rule applies for a diagonal. If intermediate C turns out to be a diagonal, the second wave can't move beyond the start of the first wave, and those are the only two structures possible if this is intermediate wave C. So a new low below this price point would provide quite a lot of confidence. It would provide enough to say we have confirmation of a trend change. And the other thing I want to note about this chart, intermediate wave C has perfect alternation between the zigzag of -2 and the double combination of -4. Fourth waves aren't always contained within channels, and this one did breach the channel, yet price turned around and moved on upward. Elliott recognised that tendency for markets to do that, which is why he developed a second technique, which is the one I'm using here, to redraw the channel when the fourth wave wasn't contained within it. Draw the channel from 2 to 4 with a copy on 3. The fifth wave commonly ends about midway within these channels, and if we continue any further up, I'd expect price to find very strong resistance at this lilac trend line. I've checked the subdivisions within -5. I know the fifth wave looks a bit like a three-wave structure. I think we have an ending contracting diagonal in here. It looks perfect on the 5-minute chart, and the trend lines look perfect as well. And so the technical analysis equivalent of that structure is a rising wedge. They're terminal structures. So at the 5-minute chart level, it does look like we've had an end to upward movement, but we absolutely need to wait for some confirmation before we can have any confidence in that. At the weekly chart level, this is the bull wave count. We only have the one bear wave count now. This bull wave count differs at grand supercycle degree. Within the bull count, I'm seeing supercycle wave 5 incomplete, cycle 3 of this impulse ended here, cycle 4, a regular flat correction, very most likely ended here, lasting 9 months, and its counterpart, cycle wave 2, lasted 3 months. These cycle degree waves are less than 1 year in duration. Now, I know the guideline for the duration of a cycle degree wave is 1 to several years, and these are both less than 1 year, but the actionary waves are well longer than 1 year. The corrective waves are often a lot quicker. Bear markets for the S&P do tend to be a lot quicker and sharper and stronger than bull markets, which is why those guidelines in terms of duration for cycle degree waves, well, for all wave degrees, are a rough guideline only, and really you'd apply those guidelines first to the actionary waves. It's most likely cycle 4 is over here for this bull wave count, because if it were to continue even further sideways, it would become grossly disproportionate to cycle 2. The only way it could continue further sideways would be as a more time-consuming flat. We could reduce the degree of labelling here down. This could be A, we could have B and then C. It could be a double flat. This could be WXY. It could be a double combination, also labelled WXY. So it would be just over halfway through. So we'd need a second corrective structure or a C wave down. And for both of those ideas, it would see cycle 4 enormously much longer in duration than cycle 2, and it would also move quite substantially out of a big channel that sits at the monthly chart level, containing supercycle 5 so far. Now, that is entirely possible, it just doesn't have a good look proportionally, and so I'm going to label cycle 4 as most likely over here. It has the best look at the monthly chart level. And so if cycle 4 is over, then cycle 5 is underway. It has to be a 5-wave structure. It's most likely to be an impulse. So far we probably have an impulse for intermediate 1 and an expanded flat for intermediate 2. We could also move this up 1 degree. This could be primary 1 and primary 2. Let's have a look at the daily chart where cycle 4, actually before we go there, the big problem that the bull wave count here has with structure is in here in primary wave C. Primary C has to be seen as a 5-wave structure. We have to see it 1, 2, 3, 4, 5, and as you can see, intermediate wave 3 very obviously looks like a 3-wave structure. It should be a 5. The only structure this third wave should be is an impulse, a 5-wave impulse, and it doesn't look like a 5 at the weekly and daily chart level. A move of this degree, of this magnitude at these time frames for the S&P should look like a 3 or a 5. It should look like what it's supposed to look like. That this one does not substantially reduces the probability of the bull wave count and increases the probability of the bear. I've looked at various other structural possibilities for cycle wave 4 and all of them have problems of Elliott wave structure. I've not been able to resolve all of those problems at this stage, but the bear count does resolve them. Okay, let's look at the daily chart now. We cycle 4 may have ended down here, and if it's ended, then we have an impulse up and still most likely an expanded flat, most likely incomplete. Now we could see intermediate 2, and remember this could also be primary 2. We could move the degree of labelling up 1 degree. We could see it over here, but it would be a remarkably brief and more especially a very, very shallow second wave correction. The first second wave correction within a new bull market really should be deeper than that, and we really should be expecting it to continue and reach down close to the 0.618 Fibonacci ratio, the most likely place for it to end, about 1920, and so it may be unfolding as a very common expanded flat correction. They subdivide 3, 3, 5. This bull wave count has to see this upward wave as a 3-wave structure, and it certainly will fit at the hourly chart level. This could be B, and we could have a 5 down for C. So at this stage, both bull and bear wave counts are expecting that price is going to find pretty strong resistance at this lilac trend line, and we're going to see a reaction about here. Both of them still need some confirmation at the hourly chart level, and both of them would be expecting a 5 down for the next move. How strong that wave is and how low it goes is going to start to tell us which wave count is correct, bull or bear. Intermediate 2 or primary 2 doesn't matter, degree of labelling has the same rule. This second wave correction may not move beyond the start of its first wave, below 1810.1. At the weekly chart level, the invalidation point is lower, allowing for cycle 4 to continue further sideways. But if we get substantial movement below this point, then cycle 4 would not make any sense as a regular flat, double flat or combination, because those are all sideways moving structures. They don't have a clear slope. And so if we get reasonable movement below this price point, I will probably cease publishing a bull wave count. The target for the bull is the same at 2500. Cycle 5 would reach equality in length with cycle 3. This bull wave count, in order to have any confidence at all in it, absolutely requires a new all-time high above 2134.72. At the weekly chart level, some classic technical analysis. Up until today, from the all-time high, we had a series of lower lows and lower highs. But today we've got an important new high above this swing high, which was back in November last year. And that's the most bullish signal from this market that we have had in a long time. However, Dow theory still puts us in a bear market because the transportations have not confirmed. Industrials have closed above their major swing high within the bear market, which began at the all-time highs back here. But the Dow Transportation Index has not. From the all-time high up here, both the Dow Industrials and Dow Transportations have closed below prior major lows within the bull market. Both Industrials and Transportations have confirmed at this point on down price was in a bear market. At this stage, we don't have Dow theory confirmation that the bear market is over and that we're in a new bull market. It's looking possible though, with a new high above this price point. This is the most bullish signal we have seen for some time. But this upward movement is coming with quite a lot of weakness in price, and that's very concerning for any bull market. This lilac trend line should hold at this stage. Price is very likely to be finding strong resistance, and as price moved up for these 2 weeks, it came on declining volume, and so there's a bit of weakness there. On balance volume last week at the weekly chart level came up to find resistance at this pink trend line. It needs to be seen how it's going to behave with this week, which is still not over. at the daily chart level, and I really need to make that a lot bigger. At the daily chart level, I'm noticing now some pretty good divergence between price and RSI. From this high, we've got a new high in price, but from this point here, RSI has not managed to make a corresponding high. This is regular bearish divergence. It indicates that we have some weakness in price, and so that also tells us that it's likely we're going to get a pullback at least of some reasonable size about this point. Price is finding resistance at this horizontal trend line, which has previously been well tested, and here's the final line of resistance, which is placed up on the all-time high. Price a couple of days ago found some support at the 13-day moving average, which for this market when it's trending is usually a pretty good area of support. And so if we're going to have a trend change, I want to see this moving average also breached. While price remains above it, we should expect the trend remains the same until proven otherwise. Although I am expecting a trend change, we still don't have any confirmation of it. We've got a reasonably long upper wick on this candlestick here and an upper wick on this candlestick. So again, further weakness. The bulls were dominant for the last 2 days and they made a very important new high for price, but they weren't able to keep price close to the highs of each day, and this upper wick for this candlestick here is longer than the prior day. The bulls are weaker still today. Overall, as price is moving up, it's overall coming on declining volume, but we do have a slight increase in volume for Tuesday's session. There was some support for the rise in price, but looking at it in a slightly bigger context, these are the 2 strongest days of the last 7 trading days, and they're both still downwards days. Within the last 7 days, it is these 2 downwards days. On those days, the bears were more active than the bulls have been active on any of these green candlestick days. ADX is still telling us there's a trend, and the trend is up. ADX is a lagging indicator. It's based on a 14-day average, but it is telling us the market is trending, and so we should be expecting support at the 13-day moving average. If price moves below that 13-day moving average, that would be a very early warning that we might not be in an upward trend anymore. But there's still something wrong with this trend. Normally during a trending market, let's just move this across a little bit so you can see the labels on the left hand side. There we go. This is ATR, average true range travelled for the day. I'll just move that back so you can see the numbers. During this upward movement back from here, this upward movement here, from here we had the low, and here the corresponding point on ATR. Overall, as price has moved up, it's coming on a declining range travelled on a daily basis. That is not normal for a trend. What it tells us is every day the bulls are less able to push price up further, and so the range at which they're able to push price up gets smaller and smaller, and they're weaker and weaker. This is not normal for a trending market. This is normal for a consolidating market. Price obviously isn't consolidating though, so what that tells us is this upward movement in price is weak. When ATR and ADX disagree, then there's something wrong with the trend. I've adjusted the trend lines today with on balance volume now that I'm going to use more data, because I want to take a look back at the bigger picture every day, back to the all-time high. So this yellow trend line is reasonably shallow. It's not too steep, and it's been tested a few times now. On balance volume is coming up again to test this yellow line, and it should find pretty good resistance there. To the downside, this purple line is reasonably shallow. It's longer held, and it's been tested about 3 times. On balance volume, when it gets down there, may find some support. A break below the purple line would be a reasonable bearish signal from on balance volume. A break above the yellow line would be a reasonable bullish signal from on balance volume. I've already noted the divergence between price and RSI. I give quite a lot of weight to divergence between price and RSI, especially when it's long held, and this one does go back quite a few weeks, and so this is reasonable. This is a good bearish signal. It tells us there's quite a lot of weakness and upward movement. I won't give a lot of weight to divergence between price and stochastics though. The last few days price has moved up to make new highs. Stochastics is flat, telling us there's some weakness, but this divergence isn't very reliable. There's also some divergence between price and MACD, but again MACD divergence isn't always very reliable. Let's take a look at VIX as an indicator of sentiment. This is the monthly chart from VIX. I had noticed some hidden bearish divergence yesterday, but that's disappeared. Now price has made a new high from here to here. VIX has also made a new high. Now that price has made a new high above this point in the last couple of days, that divergence has disappeared. We do still have though multi-month divergence between price and VIX. Here VIX has made a lower high, price has made a higher high, and that's some regular bearish divergence telling us that there's weakness to this upward movement in price. As you can see, these previous divergences noted on this monthly chart between inverted VIX and price usually is fairly reliable, so I'll give it quite a lot of weight. That's a strong indicator that at the moment this upward movement from price is weak. It doesn't tell us exactly when we're going to see the trend change though. All of these indicators are telling us there's weakness, but it can't pinpoint exactly where and when we're going to see a change. We know we will see a change. The trick is trying to figure out when. Really importantly now, 2 days in a row, inverted VIX has declined. What that tells us is for the last 2 days, although price has moved higher, completing green candlesticks, making very important new highs, volatility has increased. That is absolutely not normal for a bull market. This tells us there's something very wrong with the last couple of days of upward movement. This is quite a bearish indicator, even though it's only over a couple of days, so I would be expecting a red daily candlestick to resolve that, probably tomorrow, but certainly this week. We've got some divergence from this high in inverted VIX to this high. Price has made new highs, inverted VIX has made a lower high, and so there's some more bearish divergence, and again I will give quite a lot of weight to VIX. The AD line up until today had hidden bearish divergence. Up until this point, price had failed to make a new high above this prior high back here in November last year, whereas the AD line consistently for a long time made new highs. Now that hidden bearish divergence up until today did exist, so that does still tell us there was a lot of weakness in price, but technically today it's disappeared. It did exist up to prior to today, so there is still some weakness there in price. That's all for me at the end of the day for your extra video update, and I hope that all of our members are having a fabulous day.